guys. Welcome. We are doing our first weekend podcast, live stream, whatever you want to call it. Today we have a special guest, Greg, over here, Mr. G Money, and he will be talking about commodities, stocks that deal with hedges such as commodities, interest rates, bonds, and etc. So go ahead, Greg. Tell us about yourself.
Yeah, my name's Greg. I trade futures at the CME, CBOT, and NYMEX. I focus mainly on commodities, bonds, and equities. I'm learning more about crypto, but I'm more from the traditional currency, bonds, equities side, and into commodities, and that's what we do at Board of Trade and CME. So, yeah, that's my background. Fire away with some questions.
Great, great. If anyone doesn't know me, my name is AJ. I'm here with Cryptopedia, and I'm just a guy on the internet. So I don't have all the fancy titles like Greg. But today we're going to start looking at TLT, which is, well, what is TLT, Greg? Why don't you explain it to us? Because I don't even have that much.
TLT is an ETF. So an ETF is an exchange traded fund. Basically, you're paying somebody to manage that fund for you, and they have a promise to you, which is they will maintain their portfolio of what they say. So TLT is actually 20 plus years the US notes or US bonds. Let's pull it up. The TLT interest rate right now is right around 1%. So that means you're paying somebody $120 per share, and they're going to put your money into a pool which buys U.S. equities, or not equities, U.S. bonds and notes for a maturation of like 20 plus years. And for that, they're going to pay you 1.5%. Right now, that's what it's trading, 120, so the yield comes out to about 1.5%. You can see that on Yahoo Finance or wherever. But right now, it's paying about 1.5%, and you're paying them about 0.15%, which is the expense ratio. So say they get $20 billion or $10 billion in deposits, so you're paying them, you buy their ETF. And right now, the market price is about $120 or so. They go ahead and buy those securities on behalf of you, and you get your return. And right now, that return, given this price, is about 1.5% per year, and your expense ratio is. Anyways, that's a long way of saying this is a bond fund and a note fund. So what happens is this moves with interest rates, government interest rates. So they have a bunch of different treasuries that they have purchased for that fund, and it moves up and down based on what the actual bonds are doing, and they keep you balanced. So TLT is 120 right now, and when I look at trades, I would probably look at the expected moves, and given TLT, I would expect it to move probably 5 to 10% either direction within the next. If you're a bear, I would probably be layering in 5% above the current price, and if you're a bull, I'd be probably buying 5 to 10% lower from here on the 1 month time frame.
Gotcha. So do you want us to review the weekly?
Sure, take a look at the weekly.
Obviously, a monthly is on like a free fall right now.
Yeah.
So you're saying five? I just did right now. Sorry for the slow load line. This is because of OBS. But
so when I look at to get into trades, if I'm a bull, I'm saying, okay, I want to buy, and where am I going to buy? What's good enough for me? I try to look at some of the option pricing, volatility, and right now I would say, for me at least, 5 to 10% is what it's going to move. So 5 to 10%, call it 7%. So 7% of 120 is 120 times 0.07. Specifically, that's 120 times 0.07. Say $8.50 either way. So that would be my range for up and down. So if I wanted to say do $500 trade or so, I would be making sure that I wouldn't lose more than $500 if it goes down $8.50. If you want to do like a $100 trade, you need to make sure that you're willing to stomach that $8.50 move. That's kind of how I would do it.
So your $8.50 move, 5% that was, or 7%. That's your stop loss.
7.5. Yeah.
7.5.
Yeah, that would be me. I'm just wrong. If that happens, I'm just wrong. If I'm risking, say, $100 or $500 or whatever for that trade, I just want to make sure that my max loss is going to be right around there if it goes down, say, $10.
Gotcha. Yeah, crypto traders are usually trying to stop loss around 2-3%. So I'm guessing you're not using margin.
No.
Okay, so this is like a spot trade.
If you did want to use margin, I would do. I would be more comfortable doing long options. So say you go, if the current price is 120, say you buy some 125 or 120 or 130 calls, and then that's your max. If it goes up, great. If not, you're out and you're protected.
Gotcha. So you're basically saying use options as the hedge vehicle, so you know exactly what your loss can be.
Or to get in, yeah.
Gotcha.
If you're long stock and you buy puts, then you hedge. If you're short stock and you buy calls, then you hedge. We're looking to take an outright position. I don't know what the market's going to do, but I do think it's going to stay within these $16, 8 up or 8 down. So that's how I'm trading personally. You sell as it rallies, buy as it comes down. Whether or not I'm short right now, but I'm going to be buying in as those $8 as it comes down some more.
So I totally agree with you on that. For the entry, just wait for a little bit longer. What I'm going to do is I'm just going to put some guidelines in here so that people can see like what you're trying to say. I would be targeting an entry around $113, and that's about your $8.
So when you say entry, are you saying long or short?
I would be entering a long right now. To short right now would not be logical to me because all the selling is already being done. So to short now, I would say the order books are probably already heavily short. So the market maker, the person with all the money in the world, is going to try to take the money wherever the liquidity is, the market will flow to it. So right now the liquidity is to basically stop out all these traders that are short. If they are short and they didn't close their position already,
if they're short, their exit is going to be different.
Exactly.
When I say as it's coming down, I think increments of $8 are how much it's going to move. So whether to buy your shorts back or get long is different.
Gotcha. I get what you're saying. I'm basically assuming that this is not gonna continually break down. But if it does break down, I would also have the stop loss. So these are the 3 lines I'm drawing in just as a guide. And I'll just explain my frame of thought because I have no idea how TLT operates. I don't really follow interest rates in that sense due to the fact that I thought crypto was going to save us from inflation. So I'm just going to point out a few simple points of interest, and I'm going to basically frame my argument in the aspect of how algos operate and how institutions accumulate. So this is what I'm drawing right here. I obviously everyone can clearly see on a weekly we are dropping heavily, and then the price is kind of making a range, and in that range it's consolidating, but it's consolidating lower and lower. That's the only issue. So this is, to me, looking like a little bit of a bear flag or a descending wedge. However you want to see it, that's up to you. The point of the matter is price is getting squeezed and it's coming down to this consolidation range. So this red line is where I want to start taking my profit if I was entering in a position. And this red line is also where I would want to enter a short if I wanted to short. It depends on who wants to do what. I'm just giving you both aspects of the play.
Yeah, if it was monthly, if you're talking monthly, I would say the option pricing right now is more like say 15 to 20%.
Wow.
So they're yeah. So 15 to 20% move on a $100 stock, or what is it, 120?
I mean, $15, $20 move is basically what we're expecting, one way or the other.
Right. So if you do that's an $18 move. So like if you're a bear, you want to getting short $9, $18, $27 higher. If you're a bull, you want to be building long positions. Say maybe $18 lower, or layering in say $9, $18 lower.
So that's
Managing
interesting.
risk like that.
So you're looking at like the increment of what the
I'm
expected
looking
move
at
is.
option pricing, just kind of volatility pricing,
Gotcha.
seeing where it is. And again, I'm a bear, so
Well, you're making money.
that, that's just my personal opinion. But if I was a bull, I would be from this price. I would be waiting, to build a position, say $9, $18 lower for a whole month, just sitting on it or putting the orders in right now. Just like
Correct. Yeah, we're basically on a weekly time frame. So you're right. Like whoever wants to do whatever, they're gonna have plenty of time to do what they want to do.
Yeah.
My question was, why are you bearish on bonds?
I think I just follow kind of what the market does and try not to risk too much. So if the market's doing something, I'll hop on for a little bit. I, you know,
What do you
maybe
mean by
portfolio
something?
allocation.
Like when do you know you
Well, I
want to
don't think it's
short?
a big secret right now. It's not a big secret that bonds are going down. So I'll hop on for a little bit, and as long as you don't get wrecked, if they take a turn, big deal. You move on to the next trade.
So that's one thing that I was saying. You see this kind of consolidation it does, and then it has a sharp bounce up. You see what I'm saying? Like it tanks hard, and then it has a consolidation up. That's what I'm seeing. So this is why I drew this, and I think that next measured move that you're expecting is probably going to go to the upside. Is my
Yeah.
my thoughts on the process because it
Right.
looks.
So
Go ahead.
So in that case, the bear would look to add to his short or keep it, either say shorting more stock, buying more puts, and the bull would be looking to get long right around here and sell it, uh, sell it as it rallies.
Gotcha. Yeah. I mean, I'm totally on board with you right now. This can be played both ways. I just think the room to the downside is going to be much more limited due to the fact that this asset likes to do this right after huge drops.
Yeah, and again, per share, I'm thinking like $15 risk, $18 risk, whatever. So if it's a say a $500 trade or whatever, 500.
This is what I am expecting. If it happens, cool. If not, I don't know. But I'm going to leave this here just to see if we're right in the next
But
week or two.
again, one of the more important things is the sizing. So, given where you're expecting it to go, what's the risk? I'm saying the risk is going to be about $20 per share.
Gotcha.
If not, I'm I'm gonna whatever, big deal, next trade. But so if you've got $100 in your account, you don't spend the whole $100. If you've got however much, you need to figure out $20 per share and make sure that you're okay with it.
Right. Totally agree with
At
you.
least that's my opinion, kind of directed by
So
the option.
that's exactly what I would say. So I just drew out these lines, and then my thought is, if I'm buying in this area, this is where I'm taking profit on this line, and then if I'm letting it run, I would have a stop loss underneath it. And I'll just do a trailing stop until it actually hits, and my stop would be under the last low. Okay. So as of right now, the price has already been tanking, tanking, tanking. And then if I was trying to accumulate this position, I would try to accumulate right now, and then I would start laddering in all the way until this area. But then after this $113, I would be taking a stop loss. Because obviously my thought was that this is going to basically make a reversal and then turn around maybe at this month's end or last week of April, because I believe the last week of April is the last week of the quarter. So this selling pressure can probably just, we can just say whatever it is, but due to the fact that it's the end of the month, always on the last Friday or the second last Friday of the end of the month, people like to reallocate.
That's options. That's
Expiration.
options.
Yeah, we have triple witching coming up, basically.
Yeah, okay. At the end of the day, it's kind of fun, but if you don't have your orders,
Exactly. And usually those options are going to expire worthless anyway because the premium is out of them by now.
Yeah, they definitely. That's it.
Yeah, so it doesn't really matter. It's
well, if it's pinned right at the strike, then you don't have everything.
Oof, yeah.
Anyways, say you did want to get long, either here or wherever, and you've got $500 or $100. What do you do? So if you wanted to get long, I would say budget $20 a share of loss, maybe, and then if you wanted to stay completely protected, maybe you go to the 130 calls for next month, and those are traded what, 70 cents. So that's
Wow.
Yeah. So you buy a few of those, and then you're protected. And if it goes up, then you're making.
I would actually, I like what you just brought up. I would actually take the buying of the calls and risking the premium on that as opposed to taking a position, because it reduces the amount of money I'm putting into this position, and then I don't lose buying opportunity. It's not a wasted capital.
It helps. It helps with you being able to put on other trades. At the same time, you're limiting yourself to a month or two or wherever.
Yeah, exactly.
You're fine with sitting on it for a month and a half, and say you buy, I don't know, say it's 70 cents, right? Mm-hmm. So you buy in 100 lots, so that's 70-cent option, so $70. So if you want to throw $140 into this trade, you'd be just fine with it going over the course of a month or two. Then you drop $140 in, and just watch it. If the rally's great, if not, you just let them expire. That's one way, and then what was I going to say? The other way would be selling the puts, but you would be collecting. So if you sold the 120 puts, you would collect a lot more, but obviously you're at risk. If it goes down, you're buying the 120s or whatever puts you sold, you're going to be on the hook for $12,000.
Yeah. So you think bonds are gonna continue dropping, or do you think we're gonna make a reversal anytime soon?
It doesn't bother me either way. I think I'd probably add once or twice if it rallied, but I'm happy just kind of watching.
Spoken like a true trader. We should not have emotions affect us, Seth. That's the correct response.
If it's working, it's working great.
Right. All right. Well, Thank you for that input on bonds. How about interest rates? What are you thinking about interest rates? Do you think we're gonna increase on this next Fed meeting?
Yeah, so in our world, kind of bonds and interest rates are interchangeable, depending basically on what the Fed does. So if the Fed controls a lot, you got to expect that whichever way they want to kind of juggle in the market, it can happen. So before they were saying we want to control inflation, so we're going to raise interest rates. I think there's a big spread between what's the 10-year now? Let me take a look. The 10-year is 10-year note, which means if you give the government 10 years, they will give you, or if you give the government money for 10 years, they'll give you your principal back at 10 years, plus 2.8% per year. So right now, the 10 years trading 2.82%, and inflation is like 7.5 to 10 or whatever it is. So that's a big spread to me. I wouldn't want to be long many bonds, just because it seems like if you guarantee yourself 3% for 10 years, or per year, 3%, and then inflation happens from
What is it?
3 to 1.
8% right now?
Yeah, so this year you're -5. I don't know what you're doing next year, or the year after that, or the year after that. But it seems like you can lock in a big loss if you really want to, if inflation continues. So what they're trying to do is increase the interest rate. So they will pay you more for your money, and they're hoping that as they pay people more, prices will come down.
So let me just get that. So
Money comes out of the system. And as money comes to them instead of the system, then the prices don't rise as fast.
Gotcha. So if they increase interest rates, the bonds that you will have will pay out more?
No, the bonds you always pay the same. If you bought the bonds, the same. Now, if you bought it today and paid the price, it'd be 2.82. Now, what the government's doing is actually selling bonds, or they're not buying as many. And they're trying to take money out of the system to make money go to them instead of to rising prices.
So that's why they're increasing interest rates, because that's money coming back to them?
Money coming back to them means they have to pay out more, but it doesn't go into inflation.
Gotcha. Okay, that's something I just mentioned.
We all have more money, and they're scared there might be more inflation. So what they're doing is they're saying, give us your money, and we'll pay you 3% a year.
But why would someone do that when the S&P returns like 5% a year?
Traditionally, the S&P is around 7.5. These past 10 years, it's been better.
Yeah, it's been like 15.
Yeah.
So why would anyone want to buy a bond then?
Security. I mean, the bond is the currency of the world. So if you've got U.S. debt, that means it's going to get paid. You're not going to lose. It's not like Russian rubles or Turkish lira or Turkish bonds or junk bonds. It's the standard. So what would people want? They want to have their money safe. If that means only getting a 3% return or a 1% return, or in the Europeans' case before, they were getting negative returns. They were just paying the government to keep their money for them for 3 years or 5 years.
So basically, bonds is the safest way to invest. It's just a risk due to the fact that your 3% return might be double or half of what inflation is, and that's your real risk. Locking up capital.
So on a long term, you know that the government is going to give you your $100,000 back, your bond back. So you know you're going to get that back. Until then, you're going to be getting your anywhere from. I mean, it started at the beginning of the year, I think, at 1.5, and now we're at 2.8 because people are selling bonds.
So when somebody bought at the beginning of the year, their only choice is to either wait for that bond to mature because that money's already there, and then if they want to buy another bond to average in their percentage, that's their only option.
Well, they could sell it.
Okay, so you could sell it. Okay, I thought they're holding it for the whole term.
Yeah, they take a big loss.
Okay.
Oh well, that's sometimes.
That's interesting. I'm sure the people here who are in crypto are learning something new because we are not aware of these types of vehicles, but it's great to know. Did you want to cover BND on a monthly or do you want to just go to oil?
Sure. BND is going to yield. It's another. I believe it's the Vanguard ETF. Check it out here. BND is another fund run by Vanguard. It's got a lot more.
Yikes.
It's paying about 2%. So again, you're paying Vanguard to invest in these securities for you, and they're going to give you your return based on those securities. So right now, those fixed income securities, which are bonds, a lot of it is made up of government, U.S. government debt, but also some corporate. This one yields about 2% versus the TLT 1.5. So why would they be giving you more money? Because there's a little bit more risky stuff in it. I think that's why they're able to bump up the payment, or that's why the payment is more. So as you can see, BND is also just government debt and some other debt, which has gone way down this year. So that's what you see. And because the debt is going down, the yield is going up because people want more money in return for their risk.
Interesting. On this asset is on a weekly time frame, and yeah, as you can see, this was some intense selling for like weeks on end. Uh, and the low right here.
Yeah, and to give you an idea of how big this ETF is, I believe it's 300 billion in net assets.
Oh wow, almost the market cap of Bitcoin, I think.
It's a very large Vanguard people. The expense ratio on Vanguard, you pay them significantly less. So you're paying them 0.04% versus 0.1. So Vanguard is very cheap in terms of that. They don't take big, but they make it up on volume.
Yeah, that shows. That shows. Uh, this. What is your thoughts on this asset? Like, how would a trader approach this with this kind of heavy selling? Like, what is your measured move that you gave us on TLT?
For me, I would probably think right around that 10% move on these guys.
$7 up or down?
Or no. So there actually isn't any option price increase because it's a Vanguard one. So I would do it. What's the return? The return is 2%. So the TLT was 1.5%. So I do 25% more than whatever TLT was. So TLT was 15. If I was expecting a 15% TLT, I would probably just do 5.
Interesting. Yeah, these lines I drew.
So say somewhere around 18%.
Yeah, that's a big move. 18%.
Right. So that's for the whole year. So 5%, 5%. But I would be trying to layer in higher. So 5%. Or if you're talking about getting short from here, which I wouldn't do, be buying the puts 10% lower than just sitting on them. So I can't see yours. What's the price of the ETF? 77?
Yeah, it's at $77.06, and I am just drawing a few trend lines that I can just hopefully predict where this thing wants to bounce. And right now we're coming into the last low, which was at $76.50. And if this 76.50 is lost, you're gonna make a brand new low. And this thing, that's when shorters will open positions right under this. That's
Yeah,
when you want to.
I'd be looking at maybe, a $10 per share loss. That's what I would be expecting.
Yeah, I was saying the bounce would happen right around here at $73.50. And that's if we don't turn around right here. I am expecting someone to protect this level because of the enormous buyback that occurred right here in a short time frame. And this is a weekly, mind you. I don't know what happened on March 9th, March 16th of 2020, but whatever occurred here, I don't know if that's COVID. That might be COVID. I think this is the COVID drop. I think this is when the COVID lockdown and everything started, and that's what this drop is. Because the way that this was bought right back up, whoever entered their position here, I'm sure they took profit, but they are also probably holding this allocation long term. They might either protect this price, or this is where they're going to enter in their short and then drive it down and then follow this trend line, is what I'm assuming, because this measured move of this inverse head and shoulder didn't play out. This measured move is supposed to come to here. And the fact that it got bought up right away and then this COVID dump happened, something funny is happening in this last 2 year time frame. I don't know what shenanigans is occurring, but the fact that the price is coming back to where it was at before the COVID shenanigans even occurred, it just says something to me. I would be very wary about taking any positions. I would just say that if I was trying to get into a long, it would be right around in this consolidation range. I would not even try to short this because the amount of selling that's occurred, there's so many people probably holding shorts retail wise, all waiting to get liquidated on a quick snapback rally right like this. And the snapback rally.
What's that rally going to be? What's that rally going to be?
How high? Probably to $80. I don't think it's going to go above this last low right here.
Right. So that's what you got to plan in order. So I would say about $10 per share.
Definitely.
You got to be able to sit on it if you want to be short.
Yeah.
If you want to sell some more, you don't sell at $1, $2, $3 higher. You wait 5, 10.
Yeah, crypto people are not gonna like that. We like to get in and out, but yeah, this is a long term.
The way you do it is just put in the order.
Yeah, yeah.
If it hits, great. If it doesn't, oh well.
You hear that, guys? Do not market buy and pay fees to the exchange. Limit order, so you're not paying a fee to get into a position, and that way you are following the 4 rules of this channel. Before you enter an asset, know your entry, your exit, your stop loss, and your take profit. Without those 4 points, you are giving the money away, okay? Know your plan, because if you don't have a plan, then your plan is to fail. So that is RTA on BND. Let's go to US oil. And keep in mind, guys, we're looking at weekly time frames, okay? We are looking at these candles, and each one of these candles is one whole week of price action. Just so you know, because this is not a 4-hour, this is not a daily. You have to really be patient for these trades, and you have to let them come to you. Also, don't forget to...
Chasing things is not really a great strategy.
Exactly.
A lot. I can tell you, when you're chasing, it better be to save your butt, not because you want to make more money. You lose less money. That's the only time it's okay to chase.
Take some losses, guys. Take some losses. This is a great example of a gap fill and a great example of where this retracement could come to if this gap fails. The gap fill already occurred. Here's our resistance to come back to. And this is oil on a weekly. Come on, my computer is so slow. So I think that if this retraces back down, it's coming into this point right here. This is the point to test. If we can't go lower than here, I expect oil to rise. I don't think it's going to just keep going down like how everyone assumes, but that's just me. That's the TA for now. This is a weekly. Did you want me to go to a monthly, or is weekly okay for us?
Yeah, weekly's fine.
Also, check this out. This was a head and shoulders. And the last asset we looked at, the head and shoulders never filled. But look at this head and shoulders. The measured move would have been to around here. It did fill. It actually overshot a little bit. And this is where the market maker came in and reaccumulated. And look, here's the lowest low, a higher low. And this shows you uptrend started. And not a single low has broken. It's never taken that any low out after that. It has continued up, filled the gap. So now all the orders for the market maker are done. And now this is retail trying to figure out what the heck is going to happen next. And if this is going to retrace into a bull flag, which it already looks like it's consolidating sideways and down, squeezing out all the people that bought on this rally, if it stays here and doesn't go lower than $58, I would assume we'll go sideways and up from here. That's my plan. And then this is where I would start taking profit. Probably right here. I don't even want to be greedy with this. I'll start taking profit right at that position. And then if anything, if it comes over here and I start seeing weakness on buy volume, I would short and then reclose my position on the retracement. So that is the range that I'm seeing right now on a weekly. Tell me what you think, Greg.
For me, I would look at probably like a $7 up or down range. I'd be looking to get short, $5 above. I'd be looking to get long or getting out, $5 to $7 below. So, what does that mean? Probably I'm trading the 86 calls, or what's the current price?
Current price is $79.50.
Yeah, so like the 7. That's based on just kind of what the option price is. So within the next month or so, I think that it's perfectly feasible to see a range of like 87 to 72, and I want to be swinging long down lower, or buying in my shorts down lower, and then probably selling the rallies as it rallies $5 out or so.
Yeah, that's like a good plan. Right now, I see that it's hitting this trendline resistance, and then it's trying to do this retrace exactly like what I'm expecting. I'm expecting it probably to come back into this gap fill, which is around $58, $60 around here, and it's going to probably squeeze and then decide if it wants to go up or down, but it's going to consolidate into this triangle. Are you able to see my chart?
Yeah,
Okay.
I see what you're saying.
Okay. Is what I'm assuming. If it breaks under this red line, then I would say the shorters are going to start taking this down, and then it might retest this bottom all the way down here. But the situation, what I see right now is the reprieve bounce is in motion right now. We are trying to test the highs. I don't think we're going to just flush on down unless this rejection right here on this green trend line was the rejection. I don't have my EMAs on. I'll turn on our EMAs and stuff at another time. I just want to do it as simple as possible for everyone to see.
If I'm short right here, I'm willing to stomach. If I got 100 shares,
I agree.
I'm willing to stomach, say like seven ticks higher, 700 to 1,000 before really getting out.
Yeah, I'll tell you right now, if whatever position anyone's in, there is sellers selling right now whatever they bought over here on this dip. There are people taking their position, and that's what this huge wick is right here. So that was someone either entering a short as well. He entered a short and he got out of his long at the same time, and that's what that huge pushback is, and that's why we're consolidating now. So as people are buying up this price, he's just filling a short. Everyone who wants to buy long right now, he's allowing them because he has a big limit order short, and he's letting the price get pushed down, letting the buyers get exhausted, and then what he'll do is then he'll market short. Right now, he's letting it fill himself with a limit. Once he actually actively markets, once the buying stops, you will see the heavy selling start. That's when you're going to see everyone who bought in this consolidation start market selling because they're panicking and getting out. That's what stage is about to come here on the Wyckoff distribution model, in my eyes. And I think it's going to consolidate.
Or Russia could blow up some oil ports.
We can't predict news. In our channel, we don't predict what the news is gonna do. What we predict is what the chart is gonna do, and then the news is going to start making a headline to basically explain why the market did what it did. That's how I see it. I don't see the news being able to tell us where the market is going. I see the news.
If Russia blows up a few oil ports, I wouldn't want.
Yeah, exactly. And then right now, why would you? I mean, I can say that shorting is doable, but look at this. This is my stop loss. So if I was shorting, I would be getting out at $103. 103 is like when I'm starting to shave my position, and then I'll stomach some loss, maybe to like 110. But after 110, I'm just trying to. I'm blind. That's like trader bias. That's like me trying to force my bias onto this trade, and I would say no.
We were talking about US, but the option price maybe.
Oh, okay. Yeah, no, I'm looking at USO. Yeah, I'm looking at USO right now. USO, not US oil. I'm sorry. So we are looking at the right asset. Yeah, right here, USO. So yeah, that's my thoughts right now. I'm looking for a consolidation, and here I can even draw it on this little sucker. I forgot. I'm looking for it to do this, whatever. Maybe poke out here and then try to break this trend line. It'll try to go up. It'll consolidate, retest this trend line, and then once it knows that it's support, it's going to just shoot out. And then this is where the next battle will be, in this area, trying to see if we're going to hold this level or not. That's my assumption. And then more than likely, we are going to come back into this, test this midline range, and then break up and make the next rally to take out the people who shorted. That's kind of what I see, but only price will tell us. This is a weekly time frame, so it's going to be a while. And then if this does play out this way, this is an inverse head and shoulder. And this measured move to here is like 200 and more. This is your measured move out of this inverse head and shoulder. And then if that means
how much the portfolio allocation, how many trades are we doing a week? What are you going to make versus what's the risk?
This is long term, definitely long term. Maybe by winter.
Make $5 per share or whatever, and you're willing to hold it, and you've got a trade on.
Yeah,
this is just ping ponging back and forth. No one position should really dominate any portfolio.
Exactly. And then if you look over here on the time scale, this is not even going to break out until like February, March of 2025. So this is like going to take a long year or two to consolidate. And if this Russia thing happens and we do break this line, see, I'm assuming we're going to consolidate here and then break out later, right? But if we do break out here, this scenario is in play. This scenario of this breaking out.
1 or 2 months. 1 or 2 months and we assess after that.
Yeah, like it all depends on if buyers step up to break this high or not. If the buyers don't step up, then the shorts are going to have their stop loss right above, never get hit. They have no reason to close their short, and if they want, they can just add in. So that's how I see that one. Anything else you want to input before we move to gold?
I don't think so. I think that's oil's one of the biggest commodities that is involved in pricing everything.
Exactly. This inflation, everyone's feeling it at the gas pump, right?
Yeah, because you got to have gas to deliver your stuff. You got to have gas to get places. You got to have gas to make fertilizer. You got to have. It's just such a big input that it's important to watch, and that's why it's so volatile. People are actively trying to hedge their risk, whether it be an airline or an agricultural company, whatever. They really, really need oil, and they have to pay up to get it sometimes. That's what they got to do, and that's another reason why you see oil go nuts. Food and energy are just so big of a percentage of people's daily expenses. So just a few dollars in energy makes big ripple effects.
Definitely. I hear that Biden is tapping the U.S. reserves to keep a ceiling on the prices for oil. So
Yeah, so what they did there is they had a big strategic reserve. They bought a whole bunch a few years ago when the oil was much lower. But now they're selling it out, which is good for us in terms of percentage-wise. A giant difference. Our price at the pump, maybe 5 or 10 cents. They're trying to do another 5 or 10 cents with the E85 or the 15% ethanol extended throughout the summer. So that might be another 5 or 10 cents. But in terms of what drives pricing in gas, it's definitely the supply and demand of the world. And unless we decide to be protectionists and shut off our exports, we're at the mercy of the world oil price, unless we decide to start being shale, not exporting.
So that's crazy stuff. I actually put on gold, and I actually had a Fibonacci retracement placed over here. That's literally where we found our resistance. So I'm actually going to remove this. And then as you can see, this retracement working out perfectly. This right here is the golden pocket right here. And it actually retraced right into the golden pocket all the way. And this is from 2014, guys, all the way to 2020. Sideways consolidation, inverse head and shoulders, and then measured move of this inverse head and shoulder would have been like up to like right around here, right here at 152. But not only did we break the measured move, we even retook the high. So anyone who shorted gold all got stopped out or closed their position. And we took that high and then we retraced right back down into a nice little bull flag. And look what we did right now. We just took out that area again. And we're trying to see, is the bottom in? We are basically going to consolidate here, and it's already doing that. And it's going to try to break this high because we have no reason for this to go down until this level is breached. Until it goes under 161, or actually, let's be a little bit more conservative. Until 158 itself is broken, there's no reason for this asset to go into selling short mode. It looks like we figured out where all the money from those bonds are going. It's all shooting into gold, it looks like. I'm going to remove this Fibonacci because I want you guys to see how I place these so you can see those ranges clearly. We'll save that for another day. We want to keep things nice and simple today. But yes, that is the bottom of that range. The top of the range is right where we saw the line try to come to and then get rejected off of. Right there. And that's what gold is. This is gold, GELD. It's consolidating sideways. This was 2012. I think this was during the Europe crisis. And then after that, this right here is during the COVID dump right here. And then since the COVID dump, after all the money we've printed, here's your answer to inflation. This is why commodities are getting stronger, home prices going up, etc., etc., etc. Inflation. This is the hedge, and it's playing out. But we are in this tight consolidation, and then I'll give you another one more line that I can see clearly. Here is your This is how I see the triangle consolidation in oil to play out. I expect oil to do exactly this. It's going to consolidate into that triangle, and then it's going to test. See, we did this in oil. We already did this test, and then we broke out and we tried to consolidate back. I'm going to bring it back just a second. I'm sorry, I didn't want to interrupt our flow, but I just want everyone to understand this is how markets work, so they're not just getting too excited and going all in and getting wrecked. Did we lose our drawings on this asset? The point of the matter is it's making that triangle. There you go. All right. So it's consolidating in this triangle, and it's trying to break this trend line. And it already tried once, and now it's in this retracement mode, making a little bit of a bull flag. Once this is broken, you're going to see that upward break, like I'm saying right here, like this little drawing I did. This is what I'm expecting to happen right as this breaks. So look at gold. And I apologize for the drag, guys. My computer is so old, but it loves me and I love it. So this same consolidation that we just saw, the triangle, it actually tested here, failed, retraced, and then it broke out. And that's this triangle right here, exactly the same thing. So this is already broke out, tried to break the high, got rejected, huge correction back down. I'm guessing short institutions shorted because it didn't break. They shorted calmly knowing that they could have a stop loss $5 above and take billion-dollar positions short and wreck the heck out of all the retail people getting excited. And that's literally how that plays out in the real world. But we're not going to fall for that ever again, guys. You only need that kind of wreckage once or twice. People don't learn the first time. They need it 2-3 times, and then they'll learn. But see, it's making another consolidation triangle. We already broke above that last high, and this is a good thing. What we need to do is have buyers step up and actually break this high, and then gold will go on this next bull run. I don't know how high gold will go, but it looks like gold is about to give everyone an answer for their inflation issues right now as a hedge. But that's just my thoughts. What do you think, Greg?
If you look at the how they're kind of pricing the forward options, you see about an 18% giveaway, 16 to 18%.
Yeah.
For me, I'd be looking probably for the next month or two, like a $5.50 So for me, if I was bullish, I'd be on dips. I'd be probably paying for the 190 calls. I'm not really bearish exactly right now, so I'm probably not going to do anything puts. But I would expect it within the next month to be within where is it? 184 right now ish.
I'm gonna draw Fibonacci for the first time ever. I'm gonna draw Fibonacci. I just want you guys to see the confluence of this data. So you see this 382 that it's consolidating at. This is like an institution. Wait, I think this is actually backwards. Hold on, guys. I have this reversed. I apologize. The point of the matter is, I think that's a 786, not the 382. Regardless, I'm just going to ignore this. Sorry for taking up the time. I was just trying to do this properly so we can see what's going on. Okay, so see, that is the 786. So what happened was, this is a Fibonacci retracement. Here's the low. You take the retracement from the low to the high. Okay, you take it from the low to the high. And then this whole price is the range dictated by these red lines I already drew. Okay, so what's going on is price is trying to figure out, are we going to basically go out and up or not? And I'll tell you right now, if the price breaks out from here, which is this $185, our next target is obviously this high. But if we can close a week or two above this 185, I would think we're going to shoot for 206, 203. I think that's where the next extension level that traders will be taking profits and shorting. So this is something I want you guys to remember. 206, 203, I don't know when it's going to happen, but it's going to happen. And I can say that if this retraces back down, I would want to pick it up at the 0.5 to the 382. So between $74 and $70, between this consolidation range, if we can get this thing to come over here and swing back up, it will show huge, huge strength. So that's my thoughts. And then the stop loss
market,
right here.
The options suggest within a year it could be.
Yeah, I mean, this right here is the first level. If I don't want to show you guys all my secret sauce, but if I show you, here's your 215. to 1630 is the exact price it should be going to. That's the 1.618 extension. Okay? Why I say this is where people like me, myself, traders, will be taking a position off. We'll take our profit and we might take shorts if we see weakness. But our goal is this 1.618 extension. But this is the first area that we're not wanting to be greedy. We're taking profit off the books, especially if we're entering over here at the 0.5 from 175 to 206. If you're not taking profit on a $25 profit per share, shame on you. Always take profit. You need to pay yourself in this world. Otherwise, the market maker will retrace this so hard on you that you will be at a loss because you didn't even activate your stop loss. Now you're negative. Then you're going to cry to me and Greg saying we didn't advise you properly. No, this is not financial advice, everyone. This is for entertainment purposes only. We are here just to show you our thoughts, our opinions. It's up to you to do your own advice and your own research and take your own risk. Don't blame us. Don't thank us. We're just here to educate you. So if you have any questions or concerns, please leave them in the comments below and we will be sure to hit those up. I'm going to remove this because I do not want people getting too confused with those targets. I just want them to look at that as a path to where we expect price to go to if we're taking these positions right now. So let's just remove that. That was the game plan. And the fact that you corroborated that 215, 216 price is just, it makes sense because that's where institutions will be pushing the price. When the market goes up quickly, it's not retail who has the money to push the market this much. Okay? It's institutions who have billions and trillions of dollars who are marking up the price. Retail doesn't have money to make the market move up. Only the institutions do and the market makers because their pocketbooks are endless. They can keep buying the price up even if they are buying against themselves. There's no one who's trying to even sell. They're only buying until right here. You see? They got everyone in euphoric stage, got all retail buy, and then all of a sudden, in one quick swoop, he just sold and took all his money back from his entry over here. That's how the market works, in my eyes. If I want this asset, I told you I'm waiting for a retracement. I'm not excited to buy here. I want to buy at the 0.5, knowing I'm getting a 50% discount from the high. There's people who are trapped right here. A lot of retail bought this week and last week, all trapped here. Their liquidity is trapped until they close their position and take a loss. Or they're going to add in right now, hoping the price goes up for them to break even and get out. That's how I see it. Aside from that, Greg, any final thoughts?
The one thing I would say would just be make sure that if you get hit a bunch or if you take a bunch of losses, that it doesn't really affect you too much. Just move on next trade.
Don't. So you're saying don't go all in, right?
You don't sleep well at night. You're not.
You're overstretched. You're overstretched. You are
If you
too.
really sleep that well, then you know you've probably got too much on somewhere.
Agreed, agreed. I would like to say that in every portfolio, some allocation should be to cash, so you have ammunition to help a position that needs help, or you have a position in cash where you can take the loss and reposition that same equity later. You obviously took that trade because you had conviction for it. Market likes to go against people all the time. It's always can be more irrational than how you can be liquid. So keep in mind you gotta have some liquidity on the side because sometimes, like you said, if Russia blows up their oil reserves, oil can shoot up and it's gonna take a lot of shorts out, even though oil looks like a great short because the world is going to lithium and lithium batteries. But yeah, I completely agree with you. Be very careful. Do not lose sleep over your trades, otherwise you're doing it wrong.
Yeah, that's a good time. If you're losing sleep or losing time, really thinking about any one individual trade, you gotta scale that back.
There's always
Over
another
time,
opportunity.
there's I don't know. I'm 35. Um, I've been doing it since 2008. That was a fun time. Uh,
Good times.
yeah, but there's no shortage of opportunities. You just gotta be disciplined enough to wait to kind of where your opportunity fits for you, because it's not a game against. It's just increasing your balance slowly but surely.
I want to
Try
reiterate
to.
that. Like, I want to just say that the market will provide endless opportunities. There's always tomorrow. If you're chasing the market, you're going to lose.
If you're chasing, you're losing. If you're
Exactly.
chasing, you're definitely losing.
That, see, and that's
Unless say one time I accidentally put 100 instead of one, and at
lots.
about I want to say about less than a minute before a big crop report, and at that point, yes, you have to chase and you have to be safe to make sure you don't your account doesn't blow up. But if you're chasing, you're losing.
Why not just take the loss of that position? It was that quick.
Oh, I did. I
Okay,
did.
okay, okay. I would exit out right away. I don't care if it's a little. You can always make it back, right?
Right. That's the okay time to chase, because if it's before something big and you didn't mean to have it on, all of a sudden you're screwed. But that's in however many years of trading. I've never really been caught, because the smart thing to do is just not putting in that big of orders.
Exactly. Slowly
You got to
build your
plan for
position.
accidents too. If you're trading for the next 30 years, how many accidents are you going to have? At least 30. So like, you got to make sure. Yeah, you got to make sure that even in the worst case scenario, it hurts, but it doesn't knock
Right. I have insurance against fat finger trades. That's what Greg is trying to say.
you out. That was one time, 12, 14 years or something. That was the only time I really had to chase.
And that's good because I mean, for you to have
I was
only
fine
one,
with losing at that point. I
yeah,
was absolutely fine with losing, as long as you know that account, that 100 lot, we're talking futures here. I'm not talking season. I'm talking 100 futures. The notional value on this position was enormous, way bigger than my account. And uh, and there was a giant crop report coming. And at that point, you just that wasn't the accident. So you get out. And if you have to chase, okay.
can we ask what it was that you were trading?
That was soybean crush.
So okay, gotcha. That is a commodity for all of you guys. Future commodity, soybeans. We will look at it another time.
Cargill, that's what Cargill, Archer, Daniels, Midland, and all the bean processors.
Gotcha.
Big, giant. Cargill's the largest private company, I believe, still.
Sweet. Well, let me come to the conclusion of our conversation today. And then, obviously, if you're up to it, we can follow up in a week or two and see how all our predictions played out, and then give our second round of TA on top of that. I was going to ask you, how do you feel about crypto?
I'm very unfamiliar with crypto. We had the opportunity to buy a whole bunch at $215, and we didn't. So that kind of felt like or Bitcoin at $215. That kind of felt like a bad move. But bad trade, move on.
I'm sure you've gotten me calling you out on crypto on a regular basis back in the day. Well, at least Samit for sure, but you too. I've been hounding you guys like Bitcoin, 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 like around 2016, 2018. But what I was gonna say is, so why don't you get into it now? I mean, you missed the boat. That's fine, but why do you
Some
think?
people think it's going to 100x from here. So
That's exactly what I'm saying. Why are you not getting an allocation in this commodity or hedge or whatever?
yeah, I kind of think of it as so. Like in my tiny head, I think that as soon as Amazon and Walmart take Bitcoin, then I'm in. Until then,
You know they do already, right? Through second party.
no. I don't trust second parties like that, which is exactly the same reason I think CME and CBOT. If Amazon and Walmart let me pay Bitcoin or Ethereum or whatever, I'll trade it.
Gotcha. But like other institutions do trade it, like GBTC, Fidelity. You know, you even have big banks coming into it now. You've got Goldman Sachs. You have
I've only got so much bandwidth, and these commodities are really
volatile.
the rest of the world is enough for my tiny head. Add on something that has, I don't know what Bitcoin volatility was last time I checked. It was like 7%. It's just a lot.
10-20% of the day sometimes, man. I love it.
I mean, and the crush sometimes moves like that too. But like for me, I like to sleep.
I was just gonna say you like your sleep. I get that. I get that. Another thing was, so as of right now, you own no crypto at all. Not even like Ethereum, Dogecoin.
I think I might have bought Bitcoin, or not a lot, but a long time ago. I don't.
And you don't even know if what it's doing. You don't have your private keys. Oh goodness. Remember, Greg.
I mean, but it wasn't a lot. I mean, maybe.
It might be now. You remember you saying Bitcoin at 215. I don't know when you bought it and how much you bought, but it might be worth a few thousand right now.
At that point, you said no. You don't have time or space for this. So the
So,
proper thing would have been to say, what % chance do you think this has of winning, and then maybe do a 1% or however many percent allocation. So if I thought it was a 1% chance of actually being something, and maybe if I had $100,000, maybe I would do 1,000.
so what do you think Bitcoin is going to be? What are your thoughts? What are those percentages you're giving
My
Bitcoin?
thoughts are no, my thoughts are exactly like what I told you. I think Bitcoin, to me at least, I'll be comfortable trading it or use it.
So other than that, you don't really care.
I would go to, I don't know what allocation, but if that's an actual, yeah, I would probably buy whatever the price was at that time. I'd just buy something.
Well, here's Bitcoin for you right now. So Bitcoin has been trading all day today. It's actually up 1.5%. Looks like Ethereum is up as well. Looks like we're getting a little bit of weekend magic. We had a lot of selling pressure on Bitcoin on a weekly time base. So let's see. So this weekly candle doesn't even close until Sunday at 8. So CME closes at 4 p.m. today, and that will lock in Bitcoin CME price.
A lot of us are closed because it's.
Oh, that's right.
We're not allowed to trade if the banks are closed. Really, it's very, very slow if the banks are closed. Because obviously, how are you going to settle?
That makes sense. So there's going to be low volume. But yeah, this is Bitcoin, and yeah, it's in a little bit of a sell-off retracement mode, and then we won't know how anything plays out until Sunday at 8 p.m. That's when the new weekly candle opens. Right now, the weekly candle shows a wick on the bottom, so there is some buying happening. The low was already put in. We're not testing that low yet, so we have to see. For crypto, we're going to go to a 4-hour because to check the daily and weekly, it's too zoomed out due to the fact that it's trading 24/7. It's not 9 to 5 like traditional assets. So I'm going to go over here to the 4-hour. And I actually have a Fibonacci, so we're bouncing in my range right now between the 786 and 0.5, and it looks like it's trapped between them for a while. We're going to have to see if the 786 can hold at 37,412. If we can hold this level and not make a new low past this point, 39,000. If we can stay above 39,000 and open the new week, we can start seeing a retracement. But this looks like a little mini head and shoulders, and I might want to gun down to the 786 to test it one more time before it wants to go up. So We have plenty of time to be patient. I would say until the market opens at Sunday night at 6 is when the CME opens. Am I right? Is it Sunday at 6 or 5 for you guys?
It depends on the product.
Okay.
A lot of like the currencies and the bonds, they're open 23 and a half hours a day with the futures. So if you want to trade, S&P futures or bond futures, they're open. The cash market, which NYSE and that stuff, opens obviously for the day session, but the futures trade only. So you can get a good idea about where stuff is going to open just by futures price.
Yeah,
Show that.
Yeah, I was gonna say the future for CME opens every Sunday at 5 or 6 p.m. and that's when the actual CME opens for Bitcoin. Bitcoin is gonna trade 24 hours anyway, but the CME
cash market. But you're talking about the futures contract.
Yeah, that's the main important one because around that CME open, there's always a crazy volatility because there's a gap.
Between what you're talking about for the people who aren't as familiar with CME. CME is the clearinghouse who will guarantee that you get paid versus you're trading cash Bitcoin or whatever, spot Bitcoin. And I don't know which exchanges, but that's different because the CME acts as the exchange, meaning on the CME products, the futures products, they will be the person who credits and debits your account versus the caption or what are the
I do my trading on Bybit, but US is not allowed there. So I mean,
like
Coinbase or Gemini. Yeah.
That's just a clearing. So those are centralized markets, kind of like CME, but the futures are futures contract, not necessarily the spot Bitcoin.
Right.
You won't actually get a debit or credit into your Bitcoin wallet. You will get a debit or credit to your CME in dollars.
Gotcha. And then you guess you get to take that out later. So yeah, that was our
CME acts as the custodian. They're the ones doing the modifying.
Gotcha. They're in like how Bitcoin has a blockchain.
You submit your orders to them. They match up the orders. They say this is what's your price for it. They're doing all of that versus spot market wherever you can trade Bitcoin on, directly, or Coinbase where you can do it. So,
Interesting.
I'm not sure if Bitcoin is delivered if you get 100 Bitcoin or whatever it is. I don't know. I can look it up.
Gotcha. And then this is Ethereum on a 4-hour. We're coming into some selling pressure. It does look like we're trying to find a bottom. As long as this bottom is not breached, we can try to turn around. This is at basically $2,973. As long as we can hold that low, we can try to reverse the market up. The usual thing that happens on a Friday, since this is a holiday weekend, it might be a little bit different, but since the price has been selling off, usually on Friday and the weekends, the price is contrary to the week's price action. So if we've been going down all week, usually in the weekend, price likes to shoot up. And that's just the games the market makers love to play. And then what happens is Friday at 4 o'clock when the CME closes, whatever the price is, and whatever the price goes to in between the time until Sunday at 6, the price usually comes back. So the market maker likes to move the price around in the weekend, but when the CME opens, price usually gravitates back to whatever the price was at CME close on Friday. So keep that in mind, guys. Keep an eye on what price every asset in the crypto world is closing in at 4 p.m. today. And then you can keep an eye out on what it does over this weekend and then see if we're right on Sunday at market open. If it doesn't do it at CME market open, then there'll be a gap. Okay, so that price action in the gap will probably get filled by Monday morning 9:30 when the New York Stock Exchange opens, because the market doesn't like to leave inefficiencies like that. It likes to fill them. It's just you don't know when it's going to fill, and then if some of assets don't ever have gaps filled because they're professional gaps. So just keep all that in mind before you take a position. I just want everyone to be safe and not give money back to the market if they can avoid it. There's Ethereum. Here's our stop right here. If it does get to this, I mean, this is a great place to enter if you're not already in a position. I'm pretty sure people shorted over here and they're just letting this wave down in 3 waves. 1 wave, 2 wave, 1 more wave down. They'll close their shorts and then they'll start opening longs in this area to ride it back up. That's how I would be doing it if I was a market maker, and I'm sure the market maker has that same kind of plan. So be aware, be wary. Aside from this, Greg, do you have any questions for me, or should we just wrap it up? And
No, I think we've covered a lot. Obviously, questions. I'm sure we'll get a bunch.
yes, please feel free to leave it in the comments below, guys. I'm gonna get Greg's social media stuff, and I'll try to link it up in the below. Keep in mind he
I'll
is
be
a.
watching. I'll be watching. For now, I'll take a look at your comments, and we can respond to them.
Sounds great. And then if you guys like the video and leave a lot of comments, Greg will be back next week or the week after to follow up with us. So thank you so much.
Share the video.
Definitely share. I'm going to share the video. You guys share the video. All the followers, please share the video with family and friends. These are assets that I probably will not cover on my own, and I will probably only follow up with you guys with Greg. He has way more expertise on this field than me. I'm just a guy on the internet talking on YouTube, so he actually works.
We're all just guys clicking buttons.
Yeah, but
Once you see it that way,
you got the license though. So aside from that, guys, if you guys would please like, subscribe, press the bell for notifications, and we will follow up with you guys soon. Thank you. Boom. Go ahead. So
everything was off, so my prices were off. So let me just run through. First, it was TLT. We'll do the
TLT.
TLT. So my short term for TLT, short term like price movement would probably be like $5 up or down. Long term, and when I say long term, I mean for the year, anywhere from 140 to 100. So that would be short term, meaning a month or two is $5 up or down. So you shorting around like 123 to 125, and getting long 115-ish. So that's kind of what I would be doing for TLT. For BND, probably 25% more than that, because its interest rate is just higher. It's got a little bit more risky stuff in there. So BND would be BND is 77. So long term, I think within a year, maybe it gets to 100, 95 or 100. That's for long term. For short term, 70 to 84.
Yeah, I agree with that.
What else do we?
USO.
This might go against what I said earlier, because I didn't realize the stuff was frozen for the weekend. USO. I want to say USO is trading 80 now. So short term. So $6 or $7 up or down. So like 73 to 87. And if it really goes nuts, I think USO could go to 120 or 40. That's long. So bull or bear, short, long term, whatever, take the pick. But I definitely think that it's priced such that it's gonna move like so like $7. I think it's down to $7 up or down. That's which range it's going to stay in.
Gotcha. And what about GLD, the last one?
And GLD, I think it started working. The GLD is currently trading 184. And I think short term, it's probably going to be like $5 up or down. So within the next couple months, I think we're going to get a $5 move. Say, so if I'm bullish, I'm buying 190s. If I'm bearish, I'm buying 180 puts. And long term wise, I think, like I said before, I think that was actually right. The 184, like it could go top out.
Gotcha. All right. Well, other than that, is there anything else you want to fill us in?
So like 150 to 215, I think that's where if you're really bearish, you're buying the 60 points or 50 points. If you're really bullish, you're buying the 215.
Gotcha. All right. Well, thank you.
Protecting, obviously. Protecting yourself with the position size. You know, if you're not cool with losing 500 or 1,000 bucks, you know, don't make the trades that big because you might lose $30 a share.
Yikes. Yes, guys, please.
But that's over the full year.
Gotcha. So you basically are putting on positions for the whole year?
Yeah.
No, you do long term. Wow, I'm like trading like 4 hours.
Well, no, I'm talking about for the month or so. If I want to make $1,000 or whatever, $100, I'm going to size it such that I can stomach either that premium just evaporating. So if I pay $500 for premium, I'll be okay with losing it, or I make sure that I can stomach that $30 per share loss.
Mm. And that's all sensible. That makes sense, man. So I thank you so much for that.
Depending on what size your account is, like if your account is $200, you buy $184 spider. What? Don't margin yourself and buy more. Just sit on it, or spend $100 or whatever it is on calls if you're bullish.
That makes sense.
The point is, don't blow up your account in one trade. Just want to be able to put on. I would say you want to be able to have 5 to 10 trades on.
That's good. I mean,
cash on stuff.
I think that's like a real important thing, like explaining your strategy with calls and puts, because not everyone even knows how to trade options properly on our channel. We are always using spot, and then when we use futures, it's trading spot with leverage. So it's not like we're doing calls and puts. We're just longing and shorting on leverage.
Yeah, so everything is really, I'd say, the same. It's just what size you're doing. Like if you're trading futures, that's just trading more stock. The futures were invented really for hedging purposes. Not it. So if you've got like this $1 billion, what are you going to do? You're going to always do $1 billion with stock.
Buy Twitter.
Yeah, exactly. So it's just different sizes. Like S&P 500. What is it? The spiders, right? That costs like what 1/10 or something.
I can pull up SPY.
Yeah. So the index is like 4,400. The spiders are $440. So if you got $1 billion, do you really want that many spiders every time? No, just do the future, and that way you've got your leverage without having to do all the underlying shares.
And that makes sense, because when you have that much money, and that's what people don't understand, market cap is very important, because when you're moving around a lot of money, if there's not enough liquidity in the order book, you're going to affect the price heavily.
Chopped up.
You know, you're going to
You
be
get chopped up, you lose. When you're chasing, you lose.
exactly.
So like these are,
I mean, if you're the guy with the money, you're buying up your own. You're driving up the price or driving it down against you. If you're the only one playing in that asset with that much.
Yeah. In the end, there's only so much supply and demand.
Exactly.
Which is fine. But if you want to get it done, you want to get it done quickly, the futures are the place to go, because how long does it take to buy them? You know, 1 million shares of something.
I would not know. I would not know.
Well, when you're Vanguard or when you're Fidelity or when you're something, you got to be moving. So,
Good stuff.
or say you're right, and you want some protection, right? Your stock portfolio is worth $10 billion or something, or whatever, and you want to short a whole bunch of stuff. You see something coming, you're just like, hell, get me out of here. Or are you going to go to your whole stock portfolio and start clicking sell 10, sell 20, sell 50? Like, no.
That's exactly
just sell the futures,
right.
And have it be done with.
Right, yeah, because you won't be able to even fill your sell because you're selling it so slowly.
Right? Say you're a bank and you just did a $10 million or $10 million transaction, and you've got an interest rate that you're guaranteed. So you're guaranteed, say, a mortgage for 5%, right? So the market's still moving, but you've got your piece of paper that says 5%. So what are you going to do? I mean, you got to offset that. You want to just be exposed.
Right. So that's just hedging that out, basically.
Right. So your piece of paper is worth 5%, but what if the market moves?
Which it should anyway, right?
Yeah, the market's always moving.
Yeah, that makes sense. You always got to protect yourself.
Each time you click the button in bonds, it's like $100,000 much. So
That's like, yeah, big money. Big money.
Or if every time you click the button in beans, it's 5,000 bushels. So if you hold 1 contract of beans to expiration, 5,000 bushels of beans are going to go somewhere.
Have you ever had a situation where it got delivered on someone?
Yeah, we stored beans.
Oh wow! So you have like a.
But hold on. But at the same time, you've got an agreement to sell them later.
Gotcha.
So
okay.
You just take delivery and you already have the agreement to sell them later. You already captured the premium. But when I think each bushel of beans is 60 pounds or something. So you've got 300,000 pounds of beans sitting somewhere. You better be sure you know what you're doing.
That's what I'm saying. That's crazy amount. Wow. Yeah, I would like a delivery of some Bitcoin if I actually trade and get it. But yeah, that happens.
I'm sure some people do that. But that's what I mean. Delivered is the best. Cash settled stuff is kind of fake.
Exactly, because they're not even holding it to expiration. They're just playing the
That's
premium.
Why you see crazy things like silver, SLV, and GLD go wild, and some things like those double inverse ETFs and those triple inverse ETFs, oil times 2. That's why those things don't work. It's because they can't get the futures fast enough.
That's crazy.
Oh yeah, we're going to give you double the oil. It's like, wait a second, the oil just moved 5%. You got 50% of a hedge. So you're supposed to be up 10%, but you're really only up like 6.
Can you tell me any one of those leverage ETFs that you know of that's even going? Do you know of anyone that's profitable? Because there's a trick about those that I know
very profitable. It is not profitable for you.
Exactly. I was gonna say because those things are such a gimmick.
So I don't know. I really stopped looking at them after 2010. They just started to blow up because the markets were moving too fast. But I don't know, anything that's just double or inverse triple or whatever. You need to be careful because when the futures move, you're not going to be able to get as many as they need because they're already moving. So there's always going to be a spread between what their performance is. I mean, sometimes it works for you, but if they're selling premium, or if the price is way higher now and they roll into the next one, I don't know. It's just games they play for. Say they charge a 0.25 management fee or whatever the management fee is.
That's it. Yeah, that's what eats you. Is that?
Like Kathy Wood and ARK,
Mm-hmm.
their portfolio, they made, I want to say, 80 million in just management fees.
That's crazy because I think they're down like 50% or something. Yeah, that's
It
crazy.
worked out for them.
Exactly. I did a video on ARC recently too. I don't even remember exactly what I said in there, but I did do a video on them, and I remember that they were in the accumulation zone. They're back all the way retraced from entry.
If you think about ARK with the K, double ARK.
Right. ARC, ARKK, Kathy Wood's company.
My favorite charlatan is the Bill Hwang guy, but this lady charges 0.75% for double K, ARKK. So 0.75% of a $10 billion, it's a lot, whatever. So, I mean, how do you lose with that?
I don't know, man. I don't know what she needs that much
To
money.
give you a comparison, her 0.75 versus, I don't know, Vanguard, which is the cheapest out there, VOO, remember that one?
I'm pulling it up right now.
So, I mean, that's one of the biggest, most the biggest S&P 500 funds. There's almost like $1 trillion. I don't know. It's a ton, right?
Mm-hmm. Yeah, they're the biggest.
Their expense is 0.04%, 0.04, not 0.7. Like it's like
it's nothing compared to that's like a insane amount.
Yeah, so
This thing looks like a duplicate of S&P.
Yeah, so if you multiply it by 19, whatever the number is, that's how much. Is she 19 times better than the S&P? I don't know, but wow.
Yeah, that makes sense now. See, so people need to keep that in mind before they invest in that kind of an asset. Because I would rather just get this VOO and just let it track the SPY.
Yeah, so Spiders, I think, is that iShares? Who does that?
Yeah, that's
So whoever does Spiders, they charge 0.09, so they're double Vanguard. Way more people trade Spiders. There's better option.
Oh, SPY is Vanguard too.
I don't think Spy's Vanguard because VOO is Vanguard.
Oh, it's Spider. No, it's Spider. I'm sorry.
Yes, Spiders are 0.09 expense ratio, which is still pretty freaking low, which is kind of what you want. Low expenses, very liquid.
Why would I take Spiders over Vanguard?
More options trade.
Hmm.
But in terms of performance, I think they're going to be very, very similar.
Yeah, I mean, the charts look identical.
More I don't know. I mean, I think it's about half the size, but it's
So these are.
If you're just the mutual fund type of guy,
Mm-hmm.
you definitely want to be all. But
I'm assuming this is where like people with a lot of liquidity need to go to make trades. Like if you have hundreds of millions or billions of dollars, this is where you go to like put in money into the market without causing a splash.
I think that every bank or whatever has their own kind of product that follows the S&P and tracks the S&P. So
They're pegged.
uses the nodes.
Gotcha.
So like, yeah, you're in terms of just like brokerage. I would say Vanguard, Schwab, the big ones, Interactive Brokers, TD, all those guys.
Interesting. Well, that's good to know. I'm gonna keep all that in mind if I choose a broker like that. That's crazy. Yeah, give us your affiliate code. We'll use it. we'll add it in the links below.
My affiliate code is our website.
Oh, okay, cool. That's going to be exciting. When you do get it, we'll upload it with this video so everyone can access it. Eventually, next week or the week after when we do our follow-up video, you can have it all ready by then. If you do, we'll add it in.
Sorry for I didn't realize the pricing.
It's okay, man. It's stuff for us to let them know for next week. So they can view this video for the whole week or the whole month and they can know exactly, this is what we're expecting. Have your entry, exit, plan. You gave them the option side of the view. So all in all, this was good recording. And I'm going to stop it right